Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. In an era of headline volatility, our next guest stands out for the conservative nature of her funds, focusing on downside protection and long-term resilience. So where is she finding the biggest alpha opportunities? And how do dividend-paying stocks bolster her downside protection? I'm pleased and happy to be here joined by portfolio manager Ramona Persaud to unpack all of this and more in our conversation today. Ramona, of course, manages several funds, including Fidelity U.S. Dividend Fund. Welcome, Ramona. Great to see you. How are you?
Hi, Pamela. Nice to see you too.
Let's begin with the type of year thus far it's been for you particularly. I think it's been a pretty wild ride for a lot of different investors, and kind of curious whether you've had to switch up the playbook quite drastically over the course of the last, let's say, 5-6 months.
Really good question. It has been a wild year. That's a word that's used very frequently here in New England. I don't know if it's used quite as much up there, but I think that 2024 actually gave us was a warm up for what we're seeing this year. There were so many volatility spikes in 2024, such as the French election at the beginning of the summer, which kind of like derated a lot of French stocks. So I picked up a lot of really interesting French stocks. Then the change in macro sentiment with inflation coming down mid-year, which created this broadening out of the market away from tech into more economically sensitive parts of the market. So that was big in July. Then there was the yen carry trade unwind in early August. So the summer was pretty exciting. And then coming into the fall, it was election-related volatility. And those are sort of all different types of volatility, which prepared us for the massive volatility spike that we saw a few weeks ago. So I think if you I kind of view 2024 as reps or practice for what we've got going on this year.
That's fascinating because a lot of people have felt that they were maybe unprepared for what happened for the types of volatility this year. But as you point out, it has been a bit of a wild ride for some time around the world against the so-called U.S. exceptionalism, which worked really well. What do you think about that right now?
Yes, it's an interesting term. I think being a global person, having been born outside the US and grown up all over the world as a kid and then lived in various parts of the world as an adult, the phrase doesn't really resonate with me, probably because I have spent a lot of my time outside the US. I kind of think lots of places are exceptional for many different reasons. It's why I love running global money. I love running global funds. But that being said, maybe it's semantics. The term doesn't resonate. But the U.S. as an economy and as a country geopolitically has a lot of advantages. In the very least, big oceans around it that are hard to cross, and that's very protective. Historically, very friendly neighbors, very protective. And then, to its credit, it's built a very broad and deep economy, and therefore has a very broad and deep stock market. So as an investor, there is sort of an exceptional quality to the U.S. economy and therefore market. That being said, as we've seen this year, when you've got really wide valuation differences between such a strong, constitutionally strong market, if you will, and the rest of the world, that doesn't necessarily sustain if the valuation difference gets really wide. And coming into this year, that valuation difference was over 2 standard deviations, which is just really big. Anytime anything gets over 2, most of the data points are contained under that graph area, if you will. So that's really strong signal, and we saw that play out in the rest of the world, particularly, say, Europe, in terms of stock performance. So U.S. is naturally advantaged, but valuation matters.
Is it okay if we go straight, just sort of Europe as either the example or however you want to look at it, but how you invest versus, I mean, there are global benchmarks. There's been a great international story this year. The way that you manage money on a perhaps more global basis, is it very similar to the benchmark, for instance, or, how closely do you stick to that, or tell us a little bit about that? Because I think a lot of people are waking up to a different trade right now.
Yes. When I invest globally, which again is really fun because there's so much active return that you can capture globally, which is a different way. Another way of saying that is securities and particularly stocks can tend to be priced very inefficiently globally because it's just not as well understood as the broad, deep liquid markets like the US. The US is extremely efficiently priced most of the time. And outside of the US, if you think of like emerging markets as a quintessential example, really hard to price that efficiently because a lot of the drivers, as we're sort of seeing now in the US, a lot of the drivers are more exogenous, meaning less predictable, such as government intervention, um, decisions that are often made for non-economic reasons or don't make a lot of economic sense. You get a lot more of that outside of the US, particularly in emerging markets, which means that if you have really strong research, you can capture there's more inefficiency to capture. You can capture it really well with great research and produce alpha. So that's what makes investing across the world, including the US, really fun. And when you get these big valuation differences between the US and other developed markets like Europe or the US and less developed markets like China, say, you've got a lot of alpha opportunities to capture. So in the last year, not just year to date, I just found more names outside of the US, such as in Europe, that looked more compelling from a valuation perspective with okay enough fundamentals. So there've been some like small and mid cap, really solid healthcare companies or conglomerates, conglomerates is just like lots of different businesses stuck together under one company banner, either in Europe or even in Japan that are really cheap, not very well run, getting slightly better, which is an awesome setup for stock picking. There's been some little stapley type things, such as in the UK, European banks versus US banks got to a really interesting valuation difference.
Fascinating. And we might circle back to that as those questions going around the world. When you mention about lots of opportunities, maybe this is global as well, but companies in a new situation or companies that are going through whatever it means to be changing their business in light of tariffs or for lots of other different reasons as well. There do seem to be a lot of companies that are having a bit of a moment and they're shaking things up in a lot of cases. Is that of interest?
It's always of interest, and they're always, especially when you take the entire world into your view, there's always something going on somewhere, and you can get relatively uncorrelated risk, which is what makes it really fun. So especially the way that I've characterized this year is one that sort of has what I would call a single point of failure. There's one big variable, and that is administrative policy coming out of the US, and particularly one person that is creating so much uncertainty and fear. So we're swinging, we've got these big whipsaws from fear to greed to fear to greed based on one, again, single point of failure, if you will. And that is a really interesting setup for investing. There's a lot of shock and awe. There is not a whole lot of finesse. I kind of think of it as instead of finesse, we've got sort of a bludgeon. And that's an interesting approach. The issue is that's what drove the huge volatility spike that we saw recently. It creates a ton of fear. And as it's scary as the end investor, as an active investor, it's opportunity. I've used this term. It's an invitation to take a closer look. So that's what I have been doing. When you get these volatility spikes, you just get things that end up being priced with a lot of fear in them. And it gives you a chance to buy good businesses all around the world. So it's been an interesting and somewhat exciting time.
And in that way, just sort of complete the circle for us, because it helps you with the downside capture in the future, for instance. So if there are other bouts of volatility going forward, if you've entered at a place where you've gotten at a good price, ultimately it'll help you on the other side.
That's right. Absolutely. So I'm typically looking for really attractive, what we call down capture. So in drawdowns, this drawdown in the US market was around 20 or so percent. We've actually retraced all of that, which means net we're still down. But 20% in a short period of time is a lot. Valuation spreads or dispersion got to just above one standard deviation, which is okay. It had been pretty tight. So there's some opportunity here and there, and what I'm really looking for is my kind of what I think of as a purposeful company, companies that are really bent on dominating what they do. So they are excellent operators and they're excellent capital allocators, and there's something going on in their end markets or something going on structurally where there's fear or doubt in the market about them. So you can buy that sort of profile relatively cheap. And when the whole market dislocates because of something hugely exogenous like global trade getting rewritten, the rules of global trade being rewritten, you can get these purposeful sort of wide moat companies for a cheaper price. So that's what I use that expansion in valuation spreads or fear to do in the last month, and I continue to do. And I'm finding it to all over the world. Large cap healthcare is quite interesting right now. There's a lot of headline risk to many parts of large cap healthcare all around the world, and I love that part of the market for both portfolio construction, for its defensive, high profitability characteristics. There are some companies now that are trading at like 7 to 8 times earnings. So maybe the earnings number is not right, but maybe that's 12 times earnings versus a market that's maybe 20 times earnings. So that spread is as wide as it's been in a long time.
One of the incredible rounds of headlines came last week when there were a bevy of deals announced through various companies in the Middle East. Some of the topics had to do, well, a lot of them had to do with sort of the semiconductor space. It leads to broader topics on, what the universe is for semiconductors that work on sort of a more American-centric system versus Chinese, and there's lots of sort of headlines in there. That said, the semiconductor story got sort of a renewed discussion within the bounds of AI. I'm wondering where within the AI story and also the semi side of things is of interest to you, because everything's been so expensive for such a long time, but it's also tracked downwards over the course of this 20% haircut in markets as well.
It's a good question. There's a lot of volatility in that part of the market and that part of tech, which we can use to our advantage. So Taiwan Semi is one that I talk about a lot. It's an example of that purposeful wide moat company that has created an advantage or a lead and has sort of extended that to compounded that lead to grow wider and wider from operational excellence and capital allocation excellence. But there's some risk. There's China-Taiwan risk. There is end market demand risk. There is sort of maybe AI risk, competitive risk. So the way that I think about that risk is when it really flares up and that stock gets to more of a mid-teens multiple, call it anywhere between 15 and 20 times, or even less than 15 times when fear is really high. A lot doesn't have to go right for the stock to work. Your alpha odds improve. Another example I'll give, there's some wafer companies, they fall under chemicals. That are involved in the semiconductor supply chain that whipsaw really strongly when there is concern about global demand, global trade. They're listed in Japan, Japanese yen. One of them has a net cash balance sheet. It's run exceptionally well. I got to know it about 17 years ago when I first started looking at globals, 15 to 17 years ago when I started looking at global stocks. And I've just tracked it for a long time and nothing's changed. It's doing the same thing. It's doing it exceptionally well. It's highly cyclical. And when it's maybe 10 times earnings right now, there's a lot of fear in the stock. And they just announced another big buyback this morning or last night, I guess, in Japan as a form of capital return. So in those moments, when there's fear in the stock and the company continues to do the right thing, it's a really interesting setup. You had mentioned turnarounds before. Particularly when we've got this bludgeon quality to volatility and risk where it's extra unpredictable, I really like to lean into what we call idiosyncratic risk. So that's just companies that are more in control of their destiny than the average company. And if you're looking across the world, you get tons of those. So there are lots of turnarounds across the world that are even more interesting now, that have a lot of doubt in them. So you can get really good valuations. There are a lot of what we call special situation-y stocks. The Japanese conglomerates, tons of Japanese conglomerates that are starting to rethink capital allocation. So they're trying to work on improving their business from sort of terrible to less terrible, which would generate more free cash flow, which they want to give more of that back to investors. That is a massively good setup for stock price performance, assuming you have a good starting valuation. So every time we see an incrementally new Japanese conglomerate that wants to get better, the conviction is higher in terms of having the confidence to invest in those, as an example of a special situation.
No, it's absolutely fascinating. So the other point I was just going to kind of take you towards is the consumer in a lot of different places. And I mean, one of the things that's taking a hit, and we're kind of noticing it, I think, more from travel patterns are changing, but it's also a consumer story of just less travel, less perhaps vacation, taking the kids and going places. There seems to be a change up there. And I mean, shares of airlines, for instance, are displaying that.
Yes.
Where else places of weakness in maybe that overall kind of consumer slash, I guess, travel industry do you note?
There's travel, but there's just consumer discretionary overall, less potential spend going into the holiday period. Walmart, we've been very in touch with Walmart's CEO, CFO, and investor relations head in the last few days, talking to them about the holiday season and how they're planning for that. And it's really challenging given the tariff landscape and consumer demand and just overall rising inflation. So that informs how we should think about valuations for consumer discretionary stocks. There are a lot of very washed out stocks. So it's a question of, I think, looking at where valuations are today versus at other points of distress. One thing I'll say about trying to gauge the stress is even at peak equity market volatility in April, when you looked at credit markets, the investment grade credit spreads didn't really move that much. Went from maybe 75 to 100, and that's not distress. High yield credit spreads moved a bit, but it didn't move into distress territory. And the credit markets ended up at that point being right. Credit markets are often right. So there's not a sense of distress at the corporate level per se, which was a really good indicator for risk to the equity. So there are lots of signals we can look at to figure out when valuations that seem washed out might truly be washed out. So discretionary is an area, but even in staples, which is much more dependable during times of fear, there's a lot of washed out stocks, such as stocks that are negatively impacted by the GLP-1 analog drugs, packaged food as an example, spirits as another example. So I've been looking at a lot of those areas and finding ideas. Speaking of laggards, there are some AI laggards. So there's a big tech company listed in Korea that is exceptionally cheap because they haven't really gotten this AI thing right in the last few years. So at some point, to the extent that we can believe that they can figure it out and there isn't a massive lead that they can't close, the valuation's on our side. It may take a little while, but you need to have a long time horizon for something like that to work. It is screaming on the quant screens, and the fundamentals are sort of very choppy. And I've invested in this company for the last 20 years. And when it gets to this valuation for one reason or another, your alpha odds are pretty good. So you'll notice that I'm talking about patterns and odds. And it's really fun because it's sort of like muscle memory in a way.
Right.
But,
It's
that's what they're doing this.
Patterns and odds, but on top of that, the fact that the Korean company that exists.
Oh yeah, of course. Of course. Let's see, 2025, 20 years ago. I mean, 15, 20 years ago, I was like on the ground for years, just going, like this is what you do in your first 10 to 15 years of this career. Like you're going from Japan to Korea to Hong Kong in the space of 3 weeks, and you're just meeting like 100 companies, and it builds your muscles in a way.
So fascinating. Wow. Okay. Time for a conversation about some of those things. One of the other things that we haven't, I want to ask you about positioning in just a second, sort of as an overall discussion. But when we're going back to ACWI, how different, for instance, from the global benchmark, you invest in how you set that up. I think, as I recall, a lot of ACWI is actually financials, is it not? Like there's a whole sort of
It
weighting?
is. It's got two concentrations. One is US, which is like way oversized relative to long-term history. So the US is somewhere in the 60s as a percentage versus typically around 50 to 55% of global stocks, which is way over indexing versus its economic weight. And that has to do with technically the way MSCI indices are rebalanced has a huge momentum quality to it. So if you know this, you can actually sort of outsmart it because
more momentum.
It rebalances in favor of what's worked, which is like kind of silly. So now it's like in the 60s, the US proportion, and I'm typically structurally underweight the US. I'm even more structurally underweight the US. And what has driven that big, gapping out of the US is the glamour tech stocks. And the justification is they have driven the bulk share of free cash flow growth both versus non-glamour stocks in the US and certainly versus all other stocks ex-US. And so this has gotten a disproportionate weight. And if you invest like me, you believe that there's some measure of mean reversion or some measure of reversion, especially versus economic weight, GDP weight. So I'm even more underweight the US, and I believe and have shown that you can make that up with stock picking. So the entire time I've run global, the US has done amazingly versus the rest of the world, but we've managed to beat that benchmark with the structural underweight to the US because the stock picking opportunity is just massive. Like if you can find great companies and you buy them at fearful valuations that are laden with fear, that's how you stock pick through a structural underweight in a country or region that's just exceptional.
On that, I mean, that just sounds like so all these years outperformed, even though you have a structural underweight to the US. So
I just think there's lots of alpha to capture across the world in my style of quality value. The US has not been a quality value market, right? So that's a huge part of why I've been structurally underweight. Like Nvidia has dominated. Sorry to interrupt you. The MSCI ACWI benchmark, the most diversified global benchmark, Nvidia and its other glamour peers has dominated that bench. And so if you're me or someone like me and you're looking for value, quality is defined by returns, not necessarily growth, and yield. So reinforcing my point that if you are able to just widen your lens to the entire world, there's always something really interesting going on.
Can we call that like subtle glamour or like elegance is what you've got? I think there's another way.
I love elegance and some amount of glamour in my personal life. That is not how I invest. I invest like Costco. Not Costco the stock, that's at 50 times earnings. Costco the company. When you walk in and what you're looking for is great quality at the best value. So think of my fund like Kirkland, the Kirkland brand, which is, I don't need fancy glamour brands like Nvidia. I am happy with Kirkland liquid detergent because the per unit price is amazing versus Tide. And this is still me as a portfolio manager. I love walking into Costco and buying the Kirkland brand because the value, the price that you're paying per unit of quality is like exceptional. That is what I'm trying to do in my funds, not be glamorous.
I love it. The laundry detergent actually threw me off my question. Line of question. Okay, wait.
Sorry.
No. Sorry. What I wanted to ask you. Yes. Where did it go?
You were talking about global.
Diversification. I was just wondering. So the fact that for many years you've been structurally underweight the US and found these amazing ways to invest in different types of companies. Diversification appears at this moment, and lots of investors are following this, to just be even more important, right? And so I'm just curious, someone who's been doing it for many years, now watching this whole like, holy smokes, we need to be diversified out of perhaps the US and others. It just seems to fade this moment.
Yes, there and make no mistake, there are periods like it's been not the best period in my global mandate the last few years when Nvidia and the glamour stocks just crushed, and it was very hard to. I've learned to stock pick around one or two. When you've got 10 of them that you have to stock pick around, what you're doing is not hoping. You're basically structuring it for good enough up capture, and you know that when you get the drawdown, you're going to crush. That's kind of the strategy. And over the long term and over market cycles, you're able to stock pick around it. But when it's at its peak, you can't. So I'm going to be very clear about that. Diversification, I think of it as a continuum between conviction and flexibility. And sometimes you're paid to have high conviction or take a lot of active risk, and other times you're paid to not. And it depends on the market context. So right now, in a context of shock and awe, whipsawing, bludgeoning versus finesse, that is all adding up to higher than usual unpredictability or exogenous nature of volatility. So diversity is what will pay off, not concentration, because you cannot, what you're investing in is less predictive. So if you think of I'll put my science hat on for a minute. If you think of an ecosystem with a lot of unpredictable risk, so just an ecosystem that isn't highly controlled, what wins in that ecosystem is diversity of species, because you need a lot of different elements given the randomness of what's coming at you, because you never know what is going to help you to survive, what you're going to have to rely on to survive. So I think that instinct from science and maybe from life experience helps me to really appreciate the role of diversity in a portfolio when the variables are highly unpredictable.
Fascinating. And this is a time of exogenous risk if we've ever seen one in the markets.
There's a lot of it. I mean, at some point, the market will become more inured because the market is the best mechanism at pattern recognition over the long term. That's why it can be so hard to beat. It's an excellent pattern recognition machine. So at some point, the market will sort of tip into recognizing a pattern around the bludgeoning or around the shock and awe where it won't, I use the word inured, where it won't lean into it as much. It'll be able to see through it. And we're seeing signs of that now. And I've been waiting for my own signs that the market is becoming inured, because that will help me to concentrate more.
So that will help you to concentrate more with it. Okay, that's fascinating.
Because then the market becomes more predictable around the unpredictability.
Fascinating. That is so interesting. Okay. Give us a sense just of overall top-down positioning. So we know what you've talked about with the structural underwrite. Just give us sort of a wrap up of how.
Yes, you had asked about financials and I didn't answer that. I'm sorry. I got so excited about U.S. versus non-U.S. Yes, financials tends to be a big weight in all diversified benchmarks, maybe except the S&P 500, certainly value benchmarks. It's a big weight in global. I tend to be structurally underweight financials because I'm looking for quality. And I'm looking for downside protection, and financials, on average, banks are black boxes. So with that structural underweight, we're still able to stock pick. In terms of other sectors, I tend to have a lot of the lowest volatility, most predictable parts of all sectors. So inside of tech, I'll own boring, legacy, somewhat cyclical tech as opposed to glamour tech because I can bring down the volatility profile. Those are just more predictable. I get more steady cash flows and therefore more steady dividends off of those. And sometimes they're cheap enough to buy, like Cisco is boring and sort of turns the stomach of people who like glamour. And sometimes it's just cheap enough that you don't really need to be that predictive about what's going to happen. So P&C insurance inside of financials is a really good setup in the U.S. and Europe for a pricing cycle the last few years. So that's been a huge contributor to financials. So across sectors, the lowest volatility, most predictable parts. And then sometimes when, such as the cyclical tech we talked about, like the wafer companies, when they get cheap enough, I can lean into cyclicality when valuation's on our side.
Dying to say you can take a bite, but anyway, carry on. Okay, that's it.
Yeah.
Interesting. Okay, that's brilliant. Just a final. I think you've kind of wrapped it up. It's amazing what you have always been doing and what is absolutely en vogue right now in terms of investing for lots of very good reasons. But you're the one with the depth who's been at this for a very long time. So it's incredible to speak to you right now. Thank you, Ramona Persaud.
My pleasure. Thanks for the conversation.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.